Okay, so let's just dive right in. We're going to break down how one really successful investor, Graham Stephan, is setting up his entire portfolio for 2026. And this isn't just some theory, right? This is his actual personal playbook, what he's buying, what he's getting rid of completely, and the big idea behind all of it. It's really the million-dollar question on everyone's mind. I mean, stocks are flying near all-time highs, home prices feel totally out of reach, and you have some of the wealthiest people on the planet warning us about bubbles. So what do you do? Do you jump in? Do you get out? Or do you just freeze and do nothing? What makes this moment so weird is that you've got this perfect storm of three things happening all at once. For the first time in a while, the Federal Reserve is firing up the money printers again. At the exact same time, corporate insiders, the execs in the know, are selling off their stock faster than we've seen since 2021. And to top it all off, pretty much everything you could buy, from stocks to houses, is near its most expensive price ever. That's the world we're in right now. So with all that chaos as the backdrop, what's the first pillar of his strategy? Well, it's all about one specific asset class that he is absolutely doubling down on, with a simple, you might even say boring, but incredibly effective approach. And this quote right here, it just perfectly captures his whole philosophy for investing in stocks. It's not about chasing the hot new thing or trying to outsmart the market. Nope. It's all about simplicity. He just wants a system that works quietly in the background, no constant tinkering needed. And for him, the answer is index funds. So let's look at how he actually builds this out. He puts a whopping 75% into a US broad market ETF. If you're not familiar, an exchange-traded fund is basically like a basket that holds hundreds of different stocks. So with one purchase, he owns a piece of the S&P 500 and a ton of other big companies. Then 20% goes into international stocks, and the last 5% goes to emerging markets. So what he's done with just 3 funds is diversify across the entire global stock market. If the world economy does well, he makes money. Simple as that. But, it's not always a smooth ride up. What happens when the market takes a nosedive? Oh, he's been there. He talks about a time when he went from being way, way up to looking at his account and seeing 7-figure losses on paper. That is a shocking number to see next to your name, but it's a very real part of being a long-term investor. So the most important part is what he did next. Did he panic? Did he sell everything? No. He just kept buying his normal amount. And then he actually started buying even more. See, he doesn't see a market dip as a crisis. He sees it as a sale, a chance to buy the same great companies at a discount. It's the exact opposite of what your emotions are screaming at you to do. Okay, now for what is easily the most dramatic part of this entire playbook. While he's going all in on stocks, he's also making a huge pivot and getting rid of an entire asset class that he's been in for his entire career. And to really understand how big of a deal this is, you gotta know his backstory. The guy started his entire career in real estate way back in 2008. It was his bread and butter for years. But around 2020, he started to branch out. And now, he's made the call to sell off his entire portfolio of rental properties. So why sell? Well, at the end of the day, it all comes down to a classic trade-off. On one side, you have more money. Holding property in a crazy market like California could definitely make him richer. But on the other side, you have more time. Selling means getting rid of all the headaches, the tenants, the contractors, the late-night calls, the insurance nightmares. It's a battle between money and time. And this quote, well, it just says it all. He's hit a point in his life where he's optimizing for peace of mind, not just for maximizing every single dollar. For him, the time and the stress that comes with being a landlord just isn't worth it anymore. Especially when he can put that cash to work somewhere else with way less effort. So with real estate off the table, what does the rest of the portfolio even look like? Let's break down the other pieces that kind of complete his whole 2026 strategy. Okay, so here's the whole thing in a nutshell. Index funds are the engine, right? That's about 65 to 70%, and that's for core long-term growth. Then he's got about 20% in treasuries for stability and to have cash on hand. And finally, about 10 to 15% is in a Bitcoin ETF, which is his high-risk, speculative bet. Let's just zone in on that 20% for a second. This chunk of his portfolio is in super safe stuff, treasuries and tax-free municipal bonds. He calls this his fail-safe. It's his sleep-at-night money. But just as important, it's his dry powder. Cash that's ready to go if the market totally tanks and a massive buying opportunity pops up. And what about that Bitcoin slice, the riskiest part? He totally admits it's not for the faint of heart. In fact, it was his worst performing investment of 2025. His reasoning is that it's a long-term bet. that as governments keep printing money, people are going to look for a digital place to store their wealth. It's an amount he's 100% willing to risk losing completely. He also gives a quick shout out to precious metals. He acknowledges they've been on an unbelievable run, especially silver, which is being driven by actual industrial demand and a supply shortage. But here's the thing. While they might be great for a short-term trade, over the long haul, he's still way more optimistic about the growth you can get from stocks.
So we've seen the what, the different assets he holds, but honestly, the most important part of all of this is the how. What's the simple, underlying philosophy that ties all these moves together and actually makes the whole strategy work?
It all comes down to one simple but incredibly powerful technique: dollar cost averaging. This is the engine of his whole strategy. It just means he invests a set amount of money on a regular schedule, no matter if the market is up, down, or sideways. This takes all the emotion out of it. It takes away the impossible game of trying to perfectly time the market. It's just pure, simple consistency. And this is really the ultimate lesson here. The secret isn't some complex formula or inside information. According to him, the easiest way to win is to just do 3 things. Diversify your money, keep buying consistently, and, this is the hardest part, don't freak out and sell when the market inevitably drops. So, that's the playbook. It's disciplined, it's consistent, and it's heavily focused on just being in the market for a long time, not trying to time the market. Which really leaves us with one final question to think about. In a world that's always chasing the next big thing, is it possible that the most boring strategy is actually the most brilliant one?